I experienced through my lifetime surprises about things that never happened in my lifetime before, but happened many times in history before. Most people think that cash is safe. Cash is the least safe investment. Today, the Federal Reserve and the government is creating the liquidity that we're seeing in the markets. And it has big implications for the value of money. What is the value of money? Where does money go? Cash is going to be a poor investment, which means that if you look at the returns of asset classes and you take cash, isn't it an interesting world when you have zero or negative interest rates? And then there's the desire to create a spread in that, so the short-term rates are lower than long-term rates. And then when there's so much liquidity, it is the central bank that is making that market. So when we look at the market today, it needs the storehold of wealth, and you see it reflected in all asset classes. So that's the main driver, and it also has very big geopolitical implications, because as we come into this environment where we have the second influence, the wealth gap, the political gap, it means that the distinction of how money and the bills are going to be divided and how that will affect tax policy and the like will matter a lot. It doesn't produce immediately a general level of inflation. It negates deflationary pressures, and what it does is it produces currency depreciations over a period of time. In the 1930s, all currencies in the early 30s depreciated in relationship at that time in relationship to gold. And so what we see is the same kind of thing happening without a general level of inflation, but not just gold. It goes into other storeholds of wealth, and stocks is an important, particularly certain types of stocks it goes into, and very much the same as 1933. In 1933, March of 1933, Franklin Roosevelt severed the connection with gold, printed money, and made money available, and that was the exact bottom in the stock market. Very similar to April 9th when the Federal Reserve and the Treasury did the same thing. So that goes into other assets such as stocks and so on, creates a reflation. We're in a situation where every individual, every company, every government has a certain amount of revenue, a certain amount of expenses, and a certain balance sheet. And when the revenue goes down and to be low or inadequate relative to the expenses, and there's not an adequate balance sheet, then defaults and restructurings take place. That's true for the population as a whole, and that's true for a number of businesses, hence the policies that we're seeing. What has been true in history is that when you have an economic downturn, that's a serious economic downturn, and less effective monetary policies at that same time, and you have a large wealth and values gap and political gaps, you tend to have fighting, internal conflict. And so rising internal conflict about how to divide the wealth pie is very, very normal historically. And so that's the dynamic, I think, that we're now seeing that will become manifest in changes in tax policy and so on. The most important, the investment environment going forward will be very different from the environment of the past. I mean, think about it as a zero and very low returning asset environment, because the liquidity that's in the market is driving the excess returns of all markets down to be low in relationship to the very low cash rate. So negative real returns, not good for cash and so on. The most important thing is to know how to diversify well. And what I mean by that is to go beyond just the traditional 60-40 stock bond mix, or even the same countries, and to broaden that diversification. To include in that portfolio assets that might seem unusual. To include some gold, to include inflation index bonds, to think about the currency exposure, to think about safety as different. Most people think that cash is safe. Cash is the least safe investment. It just doesn't have the same volatility to it, but it has, because they're producing so much cash, it has a negative real return. It's a tax that maybe 2% a year you lose money in terms of cash. So you have to think about risk differently, and you have to diversify best. That's the most important thing, to have a well-diversified portfolio. The uncertainties that we have today are so great in terms of all the things I mentioned, the tax policies, the geopolitical. Certainly we must experience it with the virus. Will the next wave come back, and how will it be there? Diversification can be achieved without reducing your expected returns because of the way that asset classes are priced. If you're going to take tactical bets from those, then those tactical bets, alpha on top of that strategic, well-diversified portfolio, should have highly diversified bets deviated. Liquidity is going to be more important than before because things change in unexpected ways. Look at how, in many of the cases, the businesses that one would have thought was a good business, and let's say you're in private equity, and that you're with that company. And so the restructuring, the ability to rebalance and diversify, and to be cautious about making a highly diversified set of bets is, I think, the future. But thinking even of asset classes, thinking about the value of money. We look at asset classes and we say, oh, do I want my money to be in stocks, and which stocks? But we don't think about stocks, bonds. We think about those traditional asset classes, but we don't think about the value of money and what's going to happen in terms of the printing of that value of the money and how to diversify it well. So I think those are the things that have to be paid attention to, in much as they were important things in years prior to 1945. A bond or debt is a promise to receive currency. You're long the currency by being long in the bonds and so on. And so when debt is built up, and a lot of debt has been built up, but beyond debt, there's a lot of non-debt obligations, pension obligations, healthcare obligations, a lot of spending obligations. Those are like debt, and they all have to be met, and there won't be defaulting on that. It's politically unacceptable to default on pensioners and so on. So all of those obligations, insurance obligations, all of those liabilities are coming at us. And that then can be met increasingly by the printing of money. And so think about it. When you're holding a bond and it has no return and a negative real return, do you want to hold that asset? Who is going to hold that asset, particularly when there's so much printing of money? And that is the value, that is currency, that is cash. And so that issue, that risk, that there's a movement out of that is significant. So now we have to look at historical periods of when that were analogous to what's going on now. And that would, I think, be particularly the war years. The years when there are large deficits that are built up, there's the monetization. And so when we talk about yield curve control and interest rate controls and guidance, we're in a new world. I mean, think about it. It's so interesting. Where does the money come from? If you take Europe, for example, and you lend to banks at the central bank lends to banks at a -1%. And then, so they'll take that credit. Then they can decide when to roll it, or as they roll it forward. That means that there could literally be no debt service payments. So it is the means by which there's monetization and cash is being produced to deal with those liabilities. And that has an important implication in the value of cash, which is currency. There's no doubt that China is a very effective force that will continue to grow. Since I started going there in 1984, its income, per capita income, has real per capita income increased 22 times. It's become substantially larger in world trade than the United States, and so on. Its poverty rate's gone from 88% to 1%. So it's a force, and the interactions between that force are also going to have implications to capital flows, the effectiveness of the economies, and then the geopolitical issues.